Well, it's been a rough ride for bank stocks so far this year, with low interest rates dinging profitability. The major banks start reporting second quarter earnings this week, and here with a preview is S&P equity analyst Erik Oja. And Erik, give us a brief sense of how banking earnings will do this time around, and then we'll get into the specific companies.
Sure. Well, banking earnings are going to be nothing very exciting in the second quarter, and the reason for that is the low interest rate environment and difficult comps to trading last year, as well as a difficult global environment. The bright spots that we're looking at is that asset growth should remain high, and we're looking at credit quality as well. We think that credit quality, excluding energy, should remain very high. So lots of positives and negatives.
Now, JPMorgan is the first major bank to report on Friday, and the Fed's rate hike last December actually added $220 million to JPMorgan's first quarter revenue. So that's a pretty big number. So this sort of delayed pace of rate hikes from the Fed, it really is going to hurt some of these banks.
Sure, it hurts the largest banks the most. Bank of America, Citigroup, JPMorgan Chase, Wells Fargo. They have a lot of money at the Fed, and they have a lot of short-term investments on their balance sheets. As we saw in the first quarter of this year, those investments reacted very positively to the December 2015 Fed rate increase. So no rate increase this year or even next year possibly means a lot of revenues are not going to be there.
All right, and so is that the main thing you'll be watching in JPMorgan's report?
Well, when I open the earnings report, I think the first thing I'll look at is loan growth, and then after that, how much did they put aside in their provision? In other words, the replenishment of their reserve for loan losses. What sort of impact is energy lending having on that?
All right, and then we also have Wells Fargo on Friday, and net interest margin perhaps will be the most pronounced in Wells Fargo, right?
Sure. Wells Fargo and Bank of America are the largest banks that have the most, how do we say, the most exposure to net interest margin. So no, it's Wells Fargo because they have so much in liquid assets and also in deposits. They are very net interest margin sensitive, and they have a relatively high net interest margin. And over the last 5 years, they've had some difficulty with the net interest margin shrinking. So we have to see how well the net interest margin is holding up in Q2.
And they also have exposure to energy loans, of course, but oil has been rebounding in recent months.
Sure. Even though oil has rebounded into the mid-40s per barrel, up from as low as $26 in mid-February, the fact is that a lot of energy loans assumed an even higher price. So we are a little bit concerned that provisions will remain high in the second quarter, not as high as they were in the first quarter. The reason the provisions were high in the first quarter was that banks had to mark down energy-related lending because of the shared national credit exams. Those are over with, and oil prices are higher, so provisions should be slightly lower in Q2.
Now, also on Friday is Citigroup's results. Now, the bank passed that living will test recently, so that was certainly a positive. But what should we hear from Citi about the bank's global footprint? That, of course, has been very important to them, right?
Sure. I mean, what we really need to hear is what they're thinking about Europe once the United Kingdom is leaving. And we need to hear about what they're seeing in the European banking system, because it's very weak right now with Italian and Greek banks. What are they hearing? What are they seeing about that? We need to see how the consumer is holding up also in other regions, Latin America and Asia. Citigroup is the most global of the U.S. banks and a good barometer of the global economy. So we need to see how it's doing. Citigroup did very well in the stress tests a couple of weeks ago. The results were released, and they've done a lot of work in terms of making their operations stronger, their financial reporting. We think it's a very well-managed bank, but unfortunately, the global economy is slowing.
And just quickly, would you be buying any of these banking stocks we talked about?
Yes, we have buy recommendations on the top 4 U.S. banks.
All right, Erik Oja from S&P Capital. Thank you so much for joining us.
Thank you, Scott.
I'm Scott Gamm, and you're watching The Street.